Hello and welcome dear traders and investors. I'm glad to present to you the cryptocurrency market review presented by analysts and experts from fx.co portal. Here we go. On Wednesday, June 17, the Federal Reserve delivered the outcome of its latest policy meeting, and the message came across as slightly more hawkish than markets had anticipated. We emphasize slightly because the Fed stopped well short of signaling that additional tightening is imminent, while roughly half of the FOMC currently supports another rate hike. Policymakers gave no indication that such a move is being considered for the July meeting. Fed Chair Kevin Warsh struck a somewhat contradictory tone. On one hand, he reaffirmed the central bank's commitment to price stability and controlling inflation. On the other, he outlined a series of potential changes to how the Fed operates, changes whose long-term applications remain highly uncertain. We would not be surprised to see significant shifts in the Fed's communication framework over the coming months. That could include adjustments to the inflation target, the elimination of the dot plot projections, or even a move toward much more limited communication with the public and financial markets. As a result, we remain unconvinced that a rate hike in September is a done deal. Meanwhile, the conflict in the Middle East has officially come to an end. Under normal circumstances, that development should support risk assets and reduce demand for the US dollar by removing a major source of geopolitical uncertainty. Yet over the past several sessions, markets have behaved in exactly the opposite way. The dollar has continued to attract buyers, while risk-sensitive assets have struggled to generate meaningful upside momentum. The divergence suggests traders are placing greater weight on monetary policy expectations and inflation risks than on improving geopolitical conditions. For now, market appears more focused on the possibility of a higher for longer Fed than on the fading geopolitical risks premium. Whether the dynamics persist will likely depend on upcoming US inflation data and how aggressively Fed officials reinforce their hawkish message in the weeks ahead. Meanwhile, fresh evidence continues to emerge that crypto miners are increasingly shifting their focus from digital assets to artificial intelligence. Analysts at Van Eck conclude that demand for companies with large-scale computing and infrastructure capabilities is rising rapidly as the AI industry races to expand data center capacity. According to the report, many firms that only relied almost exclusively on Bitcoin mining are now repurposing their facilities and hardware to serve AI workloads. The reason is straightforward: AI companies are willing to pay a premium for computing power, while the supply of high-performance infrastructure remains limited. In other words, capital is flowing toward the segment offering the strongest returns. For many miners, the economists are becoming increasingly clear. Mining profitably has been under pressure due to rising competition, higher operating costs, and the long-term impact on Bitcoin halvings. At the same time, demand for AI computing resources continues to surge, creating a potentially more stable and lucrative revenue stream. As a result, a growing number of mining operators are evolving into infrastructure providers, leasing power, data center space, and computing capacity to AI-focused business rather than relying solely on crypto mining revenues. The broader takeaway is that the market is beginning to view computing power itself as the most valuable. Whether that power is used to secure a blockchain network or train large AI models is becoming a business decision driven by profitability. And right now, for many operators, AI appears to be more attractive opportunity. On the daily timeframe, Bitcoin has resumed building a bearish market structure. The trend remains firmly the downside. And the charge level has been moved up to 82,800 USD, following the formation of a fresh lower low. Until BTC reclaims and holds above the 82,800 USD, the current downtrend remains intact. Only a sustained break above would invalidate the bearish structure and suggest that the broader decline has come to an end. At the moment, however, there are still no technical signs of a bullish reversal. Momentum remains skewed to the downside, and we continue to expect further weakness in Bitcoin. A new bearish fair value gap has formed on the daily chart between 68,000 and 70,700 USD. While several smaller imbalances can be identified throughout the current sell-off, there is the most obvious and technically significant supply zone on the chart. As a result, any future retracement into this area could attack fresh selling pressure and generate new short entry opportunities. As long as Bitcoin remains below key structural resistance, rallies into bearish FVGs should be viewed as potential setups for trend continuation rather than signs of a market recovery. On the daily timeframe, Ethereum remains firmly locked in a bearish trend structure. The key CHOCH level is now located at 2477, marking the latest lower high within the current downtrend. As long as Ethereum continues trading below that level, the broader bearish bias remains intact, and there is no technical basis for calling a trend reversal. Price recently reacted with only a minor deviation to the latest bearish fair value gap, a setup that closely mirrored the signal seen on Bitcoin. The alignment between the two largest cryptocurrencies provided additional confirmation that sellers remained in control. As a result, traders had a strong technical case for initiating short positions ahead of the most recent sell-off. The rejection from the bearish FEG combined with the intact bearish market structure offered a high probability continuation setup that ultimately played out as expected. For now, Ethereum continues to trade below key structural resistance, and the daily chart remains titled in favor of the bears until proven otherwise. On the 4-hour timeframe, Ethereum continues to trade within a bearish structure, which remains part of the broader downtrend visible on both the daily and weekly charts. At the moment, the market is showing only a modest corrective rebound. And while that recovery could extend further, there is still little evidence of a meaningful shift in trend. The most recent bullish fair value gap did generate a reaction. but as the price action shows, the bounce has been relatively weak. That's a classic characteristics of a bearish market. Sharp declines by followed sluggish and limited recoveries. In other words, sellers continue to dominate the broader picture, while buyers have so far failed to generate enough momentum to challenge key resistance levels. As a result, traders may consider tactical long positions when fresh bullish patterns or setups emerge on the 4-hour chart. However, these trades should be viewed as short-term counter-trend opportunities rather than the beginning of a larger bullish move. The prevailing trend remains bearish, and Ethereum could resume its decline at any time as long as the higher timeframe structure stays intact. Until the market starts producing stronger bullish signals and reclaiming key structural levels, rallies are likely to be treated as corrective moves within a broader downtrend. That's all for today. See you online soon, and good luck.